Right now, Divo and ticker DGRW are two of my favorite dividend ETFs. Against the market, they have fantastic long-term performance with less volatility, generally speaking. And perhaps most importantly of all, I think the methodology of both funds are just rock solid. So when it comes to DGRW, they begin with 300 dividend-paying companies and rank them by growth and quality factors. Growth includes long-term earnings growth expectations, and quality is based off of historical return on equity and return on assets. And Divo is managed with a strong emphasis on owning high-quality, large-cap companies with historical dividend and earnings growth. So you can see the trend here that I like: growth, quality, dividend-paying companies. And for me right now, Divo and DGRW are the two funds that meet that criteria the best. Now, I came across this article from Simply Safe Dividends going over their opinion of the best dividend ETFs. And in this video, I want to compare their top two choices against my top two choices. Hopefully we can see what kind of metrics they value the most, and we can stack up the performance of their top two against my top two. I'll go ahead and leave this article linked down below if you guys want to check out the entire thing, all 10 names. But to get right into this, their number two choice is the Schwab US Dividend Equity ETF, aka SCHD. So SCHD tracks the Dow Jones US Dividend 100 Index, which selects high-yielding stocks with a record of consistently paying dividends and maintaining strong financial ratios. And more specifically, these are the metrics they focus on: free cash flow to debt, return on equity, dividend yield, and 5-year dividend growth rate. And they comment here saying that SCHD's quarterly dividends fluctuate unpredictably, but the funds focus on quality companies that generate free cash flow, have moderate debt, and grow their dividends have resulted in higher annual payouts since SCHD's inception in 2011. And then their number one pick is from Vanguard, and this is the Dividend Appreciation ETF, ticker VIG, which I think is the most popular dividend ETF of all time. So VIG seeks to match the performance of the S&P 500 US Dividend Growth Index. The index tracks companies that have increased their dividends for at least 10 consecutive years, excluding REITs, and the top 25% highest yielding eligible stocks. The result is a portfolio filled with high quality dividend growers. Visa, Microsoft, Home Depot, Johnson & Johnson are among the ETF's top 10 holdings. So right there, when it comes to their top two holdings, a major reason they pick these funds is because of their growth and quality characteristics. Same basic idea behind my choices, but there are some differences in methodology. So again, DGRW, their big thing is earnings growth, return on equity, and return on assets. SCHD is free cash flow to total debt, return on equity, some overlap there, dividend yield, and the dividend growth rate. So you can see some slight differences, but ultimately we're trying to accomplish the same thing. When it comes to the holdings for ticker VIG, this is the sector breakdown, fairly similar to the general market, and these are the top 10 holdings: Microsoft, Apple, Exxon, United Health Group, JP Morgan, and a bunch of other large recognizable names. SCHD has a pretty significant difference here. The sector allocation is most heavy in industrials, followed by healthcare and financials. And these are the top 10 holdings: Amgen, Chevron, AbbVie, Broadcom, Merck & Co. Very large companies, but a lot less technology and, generally speaking, slower earnings growth, although still very high quality, cash-rich balance sheets. When it comes to my two ETFs, beginning with Divo, this is the current sector allocation, and these are the top 10 holdings. Uniquely, they hold 11% in short treasury bonds right now. So this is going to add stability to the fund and give you that roughly 5% yield that bonds currently offer. But the equities consist of United Health Group, Chevron, Microsoft, Procter & Gamble, Visa, Apple. And these top 10 holdings are kind of a mix between VIG and SCHD. We have some slower growth companies like Chevron and Procter & Gamble, along with some tech names: Apple, Visa, Microsoft. And then my second pick, DGRW, this is the sector allocation. I think it's the heaviest so far in technology at 30%, and we have these as the top 10 holdings. But now the point you guys have all been waiting for, let's put all four of these names side by side. So on the 5-year view, this is what we're left with, and we're gonna go over this in extreme detail. So beginning on the left side of this chart, we can see that the standout fund here is the pink line, which is ticker VIG. This had overperformance in the pre-COVID era. During COVID, it held up decent compared to the rest of the market. It had a strong recovery, and that recovery continued to be leading up until 2022. From this point on, VIG had a bit more of a bumpy road. So excluding the outlier, which is SCHD, we're talking more about that in a second, it was the top performing fund. So it went from being one of the top performing funds to the bottom performing fund at the depths of the 2022 bear market, which isn't great. One of the main reasons people invest in income quality ETFs is for lower volatility. And going from the best to the worst performing is not achieving that. And then from this point, the performance of VIG hasn't really been anything special. Let's go ahead and take a look at SCHD now, because this one is also very fascinating. We can see that pre-COVID, it was very average SCHD in terms of other comparable dividend funds. But immediately after COVID, up until about here, SCHD did struggle and it was lagging behind. Then during the bubble of 2021, SCHD had this period of extreme outperformance, even beating the S&P 500. It also did a fantastic job maintaining the gains throughout the bear market of 2022. However, now in 2023, the fund has been fairly flat in a rising market. And then finally, my two picks, Divo and DGRW in the blue and the orange color, are kind of the middle of the pack. They are consistently good. And zooming in here, we can see that Divo is usually a little bit less growthy than DGRW. I say usually because during periods of volatility, that's when things tend to flip. So in 2018, 2019, Divo was actually one of the better performing funds. And more recently in 2022, we had a repeat of that. So Divo was the worst performer towards the end of that bubble market in 2021. But by the end of 2022, it was about even with the pack, if not one of the slightly better performing funds, and that's coming from a lower starting point. So Divo isn't the most growthy ETF ever. It began to fall behind again in the first half of this year. But whenever there's volatility, it tends to catch back up because it's more consistent and less volatile. So if you guys want to know the best overall fund, just in terms of raw numbers, technically DGRW is the best. But I think the methodology and the volatility and the behavior of the fund over time is very important and needs to be taken into consideration. For example, SCHD has great performance, second best of the pack, but it's potentially the most volatile. It has these periods of both great overperformance as well as underperformance, like we saw back in 2020, and we're seeing this year again. And I think that volatility metric is way more important than splitting hairs between a fund like VIG and Divo that has a 1% difference over time. We all know that your ability to hold on to an investment over the long term by far has a bigger impact than that 1%. So again, I think all these funds are top-notch, very comparable, and the differentiating factor, in my opinion, should be the volatility and the behavior of these funds during various market cycles, rather than just these numbers up here of the ultimate final return. And that's why I picked Divo and DGRW as my top choices. They might not have the absolute best performance ever, but throughout the past 5 years, they've been very consistently good. The volatility isn't that extreme, they're easy to hold on to, and they both pay a monthly dividend, which I know additionally helps me to hold on to these funds and stay invested during periods of volatility. Now, of course, with that said, VIG, SCHD are still extremely high quality ETFs. You really can't go wrong with either of these. It really just depends on your risk tolerance and your overall strategy and how these funds can play into them. So let me know in the comments below which one of these funds do you prefer the most. Hope you guys enjoyed, and I'll see you guys in the next one.